Welcome to Value Investing University. My name is Mariusz Konieczny, and in this video I will be talking about value investing. So what is value investing? Well, the concept is pretty simple. When you engage in value investing, all you are really doing is exchanging something of value for something else that also has value. And you do this every day, even though you might not even realize it. When you go to the mall or grocery store, why do you buy stuff? Well, because you want or need whatever that you are buying more than the cash that you used to pay for it. In other words, you compare two values: the cash in your wallet versus the sweater that you really like. If you perceive that the sweater is more valuable to you than the cash in your wallet, then you will exchange your cash for the sweater that you like. However, if you think that the sweater is not as valuable as the cash in your wallet, then you will probably not engage in this kind of transaction. And this is all value investing is all about: exchanging something of value for something else that also has value. When you invest in the stock market, you're pretty much doing the same thing. You are exchanging your cash in your wallet, or maybe in the brokerage account, for the stock of your choice. If you are watching this video, then you are probably interested in growing wealth. And it's maybe because you want to have enough money for retirement, or maybe you want to be able to afford your dream house, or maybe you just want to be rich like Warren Buffett and never really use the wealth that you accumulate. And the reason for wanting to grow your wealth is not really that important. But what is important is that you are interested in growing wealth. So let's talk about wealth a little bit. Unless you are already wealthy, you pretty much only have two choices for becoming wealthy. One, you create or build wealth yourself. Or two, you let other people create wealth and you just take it from them by either inheriting it, stealing it, or buying it. And these are the only choices that you have. So let's talk about all of these two choices. If I asked you to list a few names of people that became wealthy, which names would you come up with? Probably Bill Gates, Steve Jobs, Mark Zuckerberg, and maybe Warren Buffett. But with the exception of Warren Buffett, how do these individuals come to their wealth? Well, they created it. They created something valuable, a product or service that other people wanted. And the people who wanted these products were willing to exchange their cash so that they could have these products. You see, if you want to create wealth, you have to think in these exact terms. First, figure out problems or needs that other people might have, and then solve them by creating products or services. But you have to make sure one thing. You have to make sure that whatever you create is more valuable to people than your cost of creating them. In other words, you have to make 1 + 1 = 3. This way you get to keep the difference, which is your wealth, or you can call it profit. However, if you create a product or service that is less valuable to people than it costs you to create it, then you're not really creating any wealth. Actually, you're destroying wealth, and it's just a matter of time before you have to shut down your operation because you simply run out of wealth to destroy. And this is the kind of activity that all successful businesses engage in. They provide valuable products and services to their clients, but it costs them less to produce them than what their clients are willing to pay for them. You see, when you engage in this kind of activity and you do it successfully, you create profits. And then profits can later be reinvested to create even more value, to create even more profits, and so on and on. And this is how you create wealth for yourself and society. Let me talk about how I try to create value through the videos that you are watching. You see, I created them because I saw there was a need for quality educational products on value investing. I knew it because people just kept contacting me with all kinds of questions about investing. So I decided to create these videos. And from your point of view, you see, you bought these videos because they were more valuable to you than the cash that you paid for them. The reason for this is because these videos communicate the knowledge to you that would have taken you quite some time to accumulate. And if you were to go about obtaining this information on your own, it would have probably cost you much more than what you paid for them in terms of time and of course money. So because I created these videos for you to watch, I created value for you. And in exchange, you gave me some of your cash. But now the question is whether I created any value for myself. Because if I only created value for you, but not for me, then I didn't really create any value, right? Actually, what I did is I transferred wealth from me to you. And at this point, obviously, I don't know the answer to it, and only time will tell whether I created any value for myself. But now that you understand conceptually what is required to create wealth, let's go to the second point, which is letting other people create wealth for you. Another way of becoming wealthy is letting other people create wealth and simply taking it from them. But there are a few problems with this avenue. Unless you have someone wealthy in your family, then inheriting wealth is probably not going to happen. Well, I guess you could marry someone for money, but if you're already married, then you're kind of out of luck. But even if you could find someone wealthy to marry, why would the other person want to marry you if you don't have any money? I mean, what are you bringing to the table? So unless you look like Kim Kardashian, then this option might not be a possibility. Another option is you can steal wealth, and I'm sure there are some people who did this quite successfully, but the ones who were not as successful as it are still broke, in jail, or dead. So I don't know about you, but I don't really like this option because the downside is pretty significant. But the good news is that you can still grow your wealth by tapping into someone else's efforts, and you can do it by buying into their wealth. And here's what I mean. If you spend $10 to buy something that is worth $10, then you're not really building any wealth for yourself. You are simply exchanging $10 worth of value for another $10 worth of value. You see, in order to create wealth for yourself by buying into someone else's wealth, you have to exchange your $10 worth of value for, let's say, $20 worth of value, or $30 worth of value, or whatever amount of value, as long as it is more than your $10 worth of value. And after this type of transaction, your wealth automatically increases. And notice that you do not have to do anything other than just perform this simple transaction. And one of the best ways of doing just that is to buy into someone else's business for less than the value of the business. And there are all kinds of businesses out there that people build and and it took them a lot of work, money, and sacrifice to make them successful. And these businesses are worth something because they provide value to their customers, assuming these are successful businesses. If you can buy into some of these businesses for less than they are worth, then you are building wealth for yourself. But you might ask, okay, if I spend years and years of hard work building a business and it is finally successful at generating nice profits for me and my family, why would I want to sell all or part of it to someone else, especially for less than it is worth? It doesn't make any sense, especially when that someone else did not even lift a finger to help me build the business. And the answer to this question is you wouldn't. You would not sell your business for less than it is worth because you're logical, intelligent, and have common sense. And also, you know how hard you had to work to build the business. So with that being said, how do you buy into businesses for less than they are worth? Well, it's simple. You have to find illogical and unintelligent business owners who lack common sense. And you know where the best place of finding these kind of owners is? The stock market. What is the stock market? Let me be cynical first in answering this question. In my definition, the stock market is a place where the most illogical and unreasonable people go to destroy their and their clients' wealth for the benefit of people like you and I, meaning value investors. Well, there you go. This is my definition of the stock market. And this is one of the reasons why I like to hang out there. If you were to communicate to someone what a farmer's market is, but you could only do so with images, so you would probably use images similar to these to communicate your message. Then the person that you were trying to explain the farmer's market to would probably say something like, "Oh yeah, I get it. It is the place where people go to buy vegetables and other foods." However, if you were to explain to someone, again with pictures, what the stock market was, you could probably use images similar to these. And what do you think the reaction of the person on the other end would be? Well, I think the person would say something like, well, I think the stock market is mathematics, numbers, graphs, a scoreboard for some kind of game, or maybe betting results, for something. In other words, the person would have absolutely no idea what the stock market is by looking at these pictures. And maybe this is why so many stock market investors do so many stupid things with their money when it comes to the stock market investing, and because they have no idea what the stock market is. And before they start throwing money around, they should be shown a picture of a supermarket with shelves stocked with businesses, because this is exactly what the stock market is. It is a supermarket of publicly traded companies, and the only reasons why you should go to the stock market is to buy or sell a piece of a business. If you go there for any other reason, then you are simply gambling with your money. And to be clear, there's nothing wrong with gambling, but if you are gambling and you think you're investing, then you're just delusional. So if the stock market is nothing more than a place where people go to buy and sell businesses, why isn't it called a business market? Well, it would probably be better if it was called a business market. But businesses are not really tangible like apples or carrots. Businesses are not something that you can touch. Well, yes, you can touch the business's assets, but how are you going to touch McDonald's? You can touch a burger and you can even eat it, but that's not McDonald's. It's its product. But even though you can't really touch a business, you can still own it, just like you can own a house or a car. And to show your ownership interest, you gotta have some kind of title, right? Well, if you needed to prove to someone that you own this particular house or car, what would you do? Well, you would simply show them the title certificate. Well, the same applies to businesses. And the title to a business is simply a stock certificate. And actually in the past, investors who bought stocks would have had stock certificates issued to them showing their ownership interest in particular companies. Today, you can still get a stock certificate, in the paper form if you really want it. But most people own their stocks through their brokers in electronic forms. So to summarize the difference between stocks and businesses are simply entities that provide products and services to their clients. And if they are successful, in return they generate profits for their owners. Stocks, on the other hand, are just pieces of paper or electronic entries that tell you who the owner is. And the stock market is a place where these owners go to buy and sell their ownership interests in their businesses. And that's it. If you called your broker and told him that you were interested in buying the stock of Classic Value Investors, which is the company that I founded, he would probably put you on hold, and after a few minutes he would come back to you saying something like, "Are you sure this is the right company? Because I cannot find the ticker symbol for the company that you're asking for." Well, and this is because Classic Value Investors is a private company. I own it and it is not for sale. On the stock market, you can only buy stocks of companies that are publicly traded. So how do companies become publicly traded? Well, let's first talk about how businesses come into existence. You see, you first have to have an entrepreneur with an idea for a product or service, and in order for the entrepreneur to make his dream reality, he needs capital. And some businesses need more capital than others. For example, let's say if you wanted to start a fitness club. Well, you would need lots of capital because you would need to buy all the exercise equipment and then find a commercial building that you would have your club in. But on the other hand, if you wanted to start an electronic newsletter like I did, then you will need very little capital, because all you would need is a computer and a piece of software, and then you're in business. But with that being said, whether the entrepreneur needs little capital or lots of capital, the one thing that these two scenarios have in common is that the entrepreneur needs capital. And it's that simple. And to get this capital, he either gets it from his savings, or he needs to get it from someone else. If he gets it from someone else, he has several options. One, he can put it on a credit card. He can, two, ask his friends and family. Three, he can go to the bank. And four, he can use a venture capital firm. However, if the amount of capital required is sizable, putting it on a credit card or asking friends and family might not cut it. Also, because the majority of business startups end up failing, there are not very many banks that are eager to provide this kind of financing. And you know how it goes with the banks. If you need a loan, then you can't get it, but if you don't need one, then you can get one. So because of these reasons, many entrepreneurs end up asking venture capital firms for help. But venture capital firms, like other firms, don't provide financing out of charity. They do it because in the end they want to make money. And in exchange for providing financing, venture capital firms require the entrepreneurs to give them part of the company. In other words, the entrepreneur and venture capital firm become partners. Then over the years, when the business grows and prospers and generates profit, and it reaches a certain size, the venture capital firms want to finally get paid. And one way of getting paid is taking the company public through an IPO, which stands for Initial Public Offering. It is a process that private companies go through to sell all or part of their business to outside investors. As part of the IPO, the venture capital firms cash out and the shares begin trading on the stock market. And this is when you and I can buy into these businesses by purchasing their shares in the stock market. While many investors get excited and purchase shares of companies that recently went public, I strongly advise you against doing it. And here's why. When companies go public, the owners of these businesses hire investment bankers to help them take their businesses through the IPO process. These investment bankers work for the business owners, not for you, just like real estate agents work for the sellers and not for the buyers. The goal of the investment bankers is to simply sell the particular businesses for as much money as they possibly can. And to achieve this, they put a tremendous amount of efforts into marketing and promotion to push the prices as high as possible. From our point of view, this is not the kind of environment that is likely to produce bargain prices that we as value investors are seeking. It is not a coincidence that another name for IPO is it is probably overpriced. You see, as I discussed before, you do not build any wealth for yourself when you exchange your money for something equally valuable. But the problem with many IPOs is that it is even worse, because most of the time you are giving up more value than what you are getting back, thus destroying your wealth in the process. Just look at what happened when Facebook went public. Just look at this chart. When it went public, the stock was trading for $38 per share, and within a short period of time, the stock price declined below $20 per share. Investment bankers definitely did a great job promoting the Facebook IPO, because everyone was so excited to own it, and they bought in. But because the IPO was overpriced, the price quickly declined, and those who bought the stock when the company went public simply destroyed their wealth in the process. And it was just simple as that. So you don't want to do that. What you want to do is you want to buy into businesses on the stock market, of course, when they are trading for less than they are worth. In other words, you want to give up less value than what you are getting in return. How do you buy stocks for less than they are worth? Well, first you have to understand why stocks can be selling for less than they are worth. In other words, you have to understand why the sellers can be dumb enough to engage in transactions where they receive less in return for what they are giving up. And the answer to this question is that the sellers on the stock market are no longer the same people that started these businesses, and they do not think like business owners anymore. You see, if you ever started or ran a business, you understand what it takes. You understand that it is not easy, because you have to deal with all kinds of problems. You have to first figure out how to solve your clients' problems in order for them to do business with you. you have to deal with employees or outside contractors, and unfortunately some of them are easier to deal with than others. Then in the middle of all of this, you have to worry about doing a great job for your clients so that competitors do not come in and take them away from you. So you constantly have to juggle hundreds of things to keep everything together. And even though you're trying to do your best, problems continue to occur. But as a business owner, you're not afraid of problems, because being in business, you're solving problems all the time. So when you have a bad quarter or a bad year, it's not the end of the world. You simply figure out what is causing you to have a bad year or a quarter, and you solve this problem. If you try to purchase a business from a person and from a business person, and you offer this person half of what the business was worth, he would probably laugh you out of the room. And this is why you don't want to buy businesses from true business owners. You want to buy them from what I call electronic owners, which include hedge fund managers, mutual fund managers, day traders, and individual investors. You see, what these electronic owners have in common is that most of them have never started or ran businesses. They have very little patience, and they care about completely different things than what business owners care about. So let's talk about some of these owners. Do you think that mutual fund managers or hedge fund managers ever ran businesses? Yeah, a few of them did, but most of them have no idea what it takes. Throughout their entire lives, all they did was follow a traditional plan. They were told to work hard in school, to get good grades, so that they could get into good universities. After they scored well on their ACTs and SATs, they got into Ivy League schools to study finance or investment banking. Then after graduating with fancy degrees, they were recruited by their Merrill Lynch's or Goldman Sachs of the world. Then, they got nice salaries with yearly or quarterly bonuses, and after years of working hard and building perfect resumes, they moved up to the positions of being portfolio managers. And now they are in charge of managing billions and sometimes even trillions of dollars by buying and selling businesses that they have no idea how they operate. So, are you kidding me? What do they know about what it takes for businesses to be successful? All they know how to do is to turn on their computer, open up Excel, crunch a bunch of numbers, and make projections. But this is not how successful business owners think or operate. Some of them don't even know how to use computers. But even if some of these electronic owners wanted to think like business owners, the way that the investment industry is structured would not allow them to think like this. You see, when you are a portfolio manager of a traditional investment firm, you live and die by your short-term performance and how it compares to some kind of index. Every quarter you have to report your performance and how it compares to the index. And if your performance does not keep up with the index, then you better watch out, because your job might be in jeopardy. Because of these circumstances, do you buy extremely cheap stocks just because they're cheap? No way. You cannot afford to do this, because who knows how long these stocks will remain cheap. Okay, so do you buy a small number of really good stocks? No, you can't afford to. You buy 100 of stocks, even if you don't understand them, because if you buy only a handful of stocks and just one of them moves in the wrong direction in the short term, and if you ever bought a small number of stock, this is usually the case, you would then underperform in the short term in comparison to the index, which could cost you your job. it is much better to buy many stocks, because then at least your performance will be close to the index that you're being compared against. Your performance obviously will never be great, but this does not matter. You're not going for greatness. What you are going for is average, because average allows you to keep your job, that you can then use to support sending your child to a private school, living in an oversized house, and driving a fancy car. But even if you wanted to overcome these obstacles and manage the money that was entrusted to you in a way that a business owner would, it would be still extremely difficult unless you simply left your employer and started your own firm. And here's why. Who are the clients of the firm that you are working for? Well, pension funds, endowment funds, retirees, and funds of funds. Do you think these clients think like business owners? No, they have the same short-term oriented mentality, and they are clueless about what makes businesses grow and prosper. So if you underperform in the short term and your employer does not fire you, then your clients will fire you, or they will simply keep redeeming their money until your employer gives in and fires you in the process. So to keep your employer and clients from being unhappy, what do? Well, you play it safe. You over-diversify by buying lots of stock in big companies that are stable and do not experience any problems. Oh no, problems are bad. In other words, you buy what everyone likes, and you don't worry about whether you are overpaying or underpaying for them. Valuation does not matter. What matters is that you keep your job. So what should you buy? Well, it is simple. To be a value investor, you should buy what is cheap. And this usually requires you to buy what others don't want. Others don't like uncertainty, so you buy uncertainty. Others don't like problems, so you buy stocks in companies with problems. Others don't like small cap companies because of liquidity issues, so you buy small and illiquid stocks. You see, if you buy what is hot and popular, then you're going to have to pay up for it. And don't take it from me, take it from Warren Buffett, who said that you pay a very high price in the stock market for a cheery consensus. It is so logical to follow this plan and buy what others don't want, but it is probably the hardest thing for investors to do, because it feels a lot better when others agree with you. It is no fun to be a contrarian who goes against the opinion of others. But the bottom line is that no one really cares about how you feel, especially the stocks that you're buying or selling. You see, your number one goal is to buy into companies for less than they are worth. And to do that, you have to learn how to think independently, and a lot of times it requires you to go against the crowd, because the crowd could be wrong. Let me give you some examples of how I benefited from buying into businesses that others feared or hated because of problems and uncertainties. This is a chart of a company called Arctic-Cat, which manufactures snowmobiles and ATVs. Everything was going fine until 2008. The company was making money consistently, and everyone was happy. And as a result of this, the stock was priced correctly. At this point, I was not really interested in buying the company's stock, but then problems emerged. Because of the Great Recession, many people curtailed their discretionary spending, which included purchases of snowmobiles and ATVs. This obviously had a negative effect on the company's financials, and which caused it to lose money both in 2008 and 2009. And oh boy, problems. The market does not want to see problems. Sell, sell, sell. The stock price collapsed from about $20 per share to almost $2 per share in less than 2 years. This is when I became interested. I knew that investors did not want to touch Arctic Cat because of these problems. But I also felt pretty confident that the company's problems were only temporary. You see, if you buy a snowmobile or an ATV, it doesn't cost you that much per month if you finance your purchase, with a dealer. Maybe, $40 to $70 per month, but this is how much money people spend going out to eat. So I felt that it was just a matter of time before, people started buying these toys again. And as it turned out, I was right, because the company did return to profitability. And look at what happened to the company's stock. It was almost a 20 bagger. And these phenomenal returns were only possible because of the idiots who chose to sell it at ridiculously low prices. Anyone who has been selling at these low prices was not thinking logically, because it did not make any sense. The company was much more valuable than what it was selling for. Let me give you another example. This is a chart of a company called Mitcham Industries. Just look at it. The stock price collapsed from almost $20 per share to almost $2 per share in a matter of months. Why? Well, the company helps oil and gas companies find oil and gas reserves in the ground by leasing seismic equipment to them. What seismic equipment does is tell oil and gas companies where to drill. And this is really important because as an oil and gas company, you don't really want to drill just to find out that you drilled in the wrong place. It is very expensive to drill, so you want to make sure you drill in the right place. When the stock price collapsed, it was because the price of oil went down from like $145 per barrel to almost $30 per barrel. And as a result of this, oil and gas companies stopped looking for oil and gas, and this obviously hurt Mitcham Industries' business. The company was still profitable, but it was not as profitable as before. And while everyone else was trying to get out, I became interested because I knew that this was only temporarily. We keep driving our cars, and oil and gas companies have to keep looking for new reserves to satisfy our appetite, which means that they have to keep using companies like Mitcham Industries. Again, this common sense turned out to be true, and within months the price of oil recovered and oil and gas companies started using Mitcham Industries again. This over time showed up in the company's income statement, and look at this chart. The stock price recovered from almost $2 per share, and it reached as high as $27 at the beginning of 2012. It was a 10-bagger, and it was all possible because electronic owners were willing to exchange something very, very valuable for cash that was much less valuable. While these examples make investing look very easy, I want to make sure that you understand one thing. I don't want you to think that in order to get these kinds of returns, all you need to do is to be a contrarian and buy into problems. No, you have to think for yourself and be able to distinguish between temporary problems and long-term problems. For example, it is no secret that Blockbuster Video has been experiencing problems with its business model. But I don't believe these problems are temporary. You see, their business is being replaced by technology, and in my opinion, it will just keep getting worse and worse for them. If you buy into long-term problems, thinking that they are short-term problems, well, then you might destroy and lose a lot of wealth in the process. Look, the bottom line is this. You don't just buy what others don't want just because. You do it because when others hate something so much, you have a good probability of buying it for less than it is worth. And this is your ultimate goal. Being a contrarian is simply a tool for achieving this goal. If you can't buy it cheap, it doesn't do you any good to be a contrarian trying to go against the crowd. As a value investor, one of the most important skills that you can acquire is to learn how to value companies. If you don't know this, then there's really no way to know whether you are buying the stock of a company for less than it is worth. While this is not a video about how to value companies, I do want to talk about it a little bit. But for more detailed instruction on how to value companies, I encourage you to watch my other video titled How to Value a Company. But in general, businesses are valued based on the amount of money that they generate for the owners. And what I mean by the amount of money is the profits that are left over after expenses. You see, a business is not worth much unless it generates profits. For example, what good does it do for you to have a business that makes $1 million a year in revenues but loses $500,000 a year after expenses? This kind of business is a liability because you have to constantly keep putting new money into the business just to keep it alive. So the key to valuing businesses is learning how to count profits. And you might think that this would be easy, but it is not as simple as it sounds because of several reasons. You see, accounting standards require businesses to report their business activities according to various different rules. And these rules could distort true profitability of companies. As investors, we have to know these rules and how to tweak them to arrive at profitability figures that are useful to us and are helpful in valuing companies and not that are useful to accountants. I don't want to spend any more time talking about valuing here because, as I said before, I have a separate video on how to value companies. So for now, let me just move on to the next point. In a perfect world, you would buy the stock of a company for, let's say, 50 cents when it was worth $1, and then you would resell it for $1 per share just a little bit later. In the process, you would double your money, and then you could take your profits and or original capital and do it again and again. An investment is this simple. You buy a stock for less than it is worth, you hold it until the price reaches the value that you originally estimated, and then you sell it. However, the problem is that you never know with precision how long it will take for the market to realize the value and price the stock correctly. Assuming, of course, that you were right with your analysis. If you are not right, then you might have to sell at a loss immediately after you discovered your mistake. Because of the uncertainty of how long it will take for the price to reach the proper value, you have to wait and wait and wait. And most of the time it takes years for the investment thesis to play out. And while you wait, all kinds of things happen. For example, other stocks that you could have bought are going up and you're still waiting. the market is going up and your stocks are still flat or even declining in price. Additional problems happen with the companies that you bought because just because you bought them doesn't mean that the problems will go away. And as a result, the stock can go down even further. And because of these things, you can get shaken out of your position and you lose patience. And in the end, you might sell out before the investment thesis plays out. I cannot tell you how many times I have had friends read about an investment idea on my blog and then manage to lose money on it, even though the stock turned out to be profitable in the end. They simply lost patience and sold out at a loss. Then they usually come back to me and complain, and I always say, look, I cannot give you patience. I can give you stock ideas, but I cannot give you patience. You either have patience or you don't have patience. There is nothing I can do about your lack of patience. I cannot overemphasize this enough. If you are attracted to value investing and because it makes sense to you, well, this is great because it should make sense. But unless you have literally an unlimited amount of patience to wait and wait and wait and wait, you should just forget about value investing and find something else to do. Now I'm going to give you some guidelines for when to sell. Number one, you sell because your investment thesis played out and the market finally priced the stock at a value that you originally estimated. Number two, you sell because you made a mistake and it happens all the time and you should just accept it. Number three, you sell because you need to raise some money to buy something else that might be even more undervalued than what you are currently holding. And this is an okay reason for a sale, but I want to warn you about something. There is always a better idea out there. When you learn about a new investment opportunity, it is exciting. But then after you sit on it for several months, the excitement wears off. So just be aware of it. If you want to sell because you found something else, ask yourself this question first. Is this something else really better? Or am I just getting bored with what I hold? You see, you don't want to be jumping from one stock idea to another and never allow any of them to come to fruition. Another thing that I want to point out is that after you sell for whatever reason, just be okay with it and don't feel bad if the stock price continues to appreciate. If you dwell on it too much, you will literally drive yourself crazy. Just assume that it will go up right after you sell it, and then you'll be fine. I mean, look, I gave you an example of how Arctic Cat stock increased from about $2 per share to $43 per share. Do you think that I bought it at $2 and sold it at $43? No. I didn't buy it at $2 per share. I bought it when it was $3 something and then sold it for $18 or $19 per share. I don't even remember. Then after I sold it, I still saw it double. Did I ever question myself how much money I could have made if I just held on to it a little longer? Well, sure I did, especially since many of the things that I bought with this money did not even come close to this kind of performance. At least not yet. But this doesn't matter. When you decide to sell, just sell and move on and don't look back. In this video, I gave you an introduction to value investing, which in my biased opinion is the only way that stock market investors should invest their money. While it is the most logical of all the investment strategies, it is also one of the hardest to stick to. In order to be successful with value investing, you have to think like an owner and buy stocks as if you were buying entire businesses. You have to take the time to learn about the individual businesses that you are trying to buy and the industries that they operate in. You have to learn how to value them so that you do not overpay for them. And then you have to have lots and lots of patience to wait until the investment thesis plays out. With that being said, I can teach you about value investing, but I cannot teach you how to be patient. The patience part is totally up to you. So thanks for watching, and I hope you enjoyed it.